As we near the end of June, we are reminded that August 2nd is quickly approaching, and that, of course, is a deadline that Timothy Geithner put forth as the deadline to raise the debt ceiling. Are we likely to see bipartisan agreements with this budget and debt ceiling before this deadline?
Well, the short answer is probably yes. All right.
Encouraging.
But the real questions are really ones of how messy will the process be, and what will be the size of the deficit reduction and its composition. Mm-hmm. And the reason I say probably yes is it's pretty much everybody agrees it's unthinkable to miss the date and create uncertainty that threatens default of
right.
U.S. Treasury securities. It's just a place that nobody wants to go.
Absolutely.
So let's kind of look at what we do know about the current situation. There actually is quite a bit that we know, and let me just spell it out here, but it does give me optimism about the outcome. So first of all, we know that Vice President Biden mm-hmm. is holding regular negotiating meetings, and that they are, both Democrats and Republicans are at the table, and this is serious business. So during the week of June the 13th, 3 meetings were held. That was last week. And during the current week of June 20th, 3 meetings are scheduled, Tuesday, Wednesday, and Thursday. And so there's serious work underway, serious discussions. We also know that the debt ceiling needs to be raised by at least $2 trillion mm-hmm. so that Congress won't have to deal with that issue again until after the 2012 presidential mm-hmm. election. And we also know that both Democrats and Republicans really don't want to have to deal with this issue again of the debt ceiling until after the presidential election.
Right.
So there's agreement there. You won't have them kind of dancing and hugging each other and so forth, saying we both agree, but you read between the lines and there's definitely agreement on mm-hmm. that. We also know that the Republicans early in the process drove a stake in the ground and said that the deficit reduction needed to at least equal, if not exceed, the amount of the increase in the debt ceiling. Well, if the debt ceiling needs to increase $2 trillion, that means you have to find deficit reduction of $2 trillion. Now, the time frame, everybody agrees, is 10 years. All right, mm-hmm. so it's $2 trillion over 10 years. So I think the most likely option, it's not certain yet, obviously, but the most likely option is that we will get deficit reduction in excess of $2 trillion. I'll throw out a number, $2.4 trillion.
Okay, so right above $2 trillion.
So it's comfortably exceeded.
Okay.
And it'll be over a 10-year period. And that this agreement likely will be reached in principle, but not in detail, by early July, and not August the 2nd. Now, why do I say early July? Well, you will still need time for the committees of Congress, both in the Senate and the House, and the Congressional Budget Office mm-hmm. to do the scoring and legislative writing and work mm-hmm. out the details, all right? And so if you work backwards from August 2nd and you say, well, that's really a hard date, having 3, maybe 4 weeks ahead of that time to have reached an agreement in principle is a reasonable time frame to do the tidying up.
Okay.
So here's then some specifics that you might find in the agreement. And these are all ones that are on the table and have been talked about, and that's undoubtedly the subject of Vice President Biden's negotiations. Mm-hmm. But let me just list to some of them. There are probably some pretty easy ones. There's been estimate that $200 billion over a 10-year period could be easily cut by making adjustments in farm subsidy programs, mm-hmm. federal retiree benefit programs, sorry if you're a federal employee, and other things of that sort. So it's kind of a little here, a little there, but mm-hmm. would all add up to about $200 billion. There is talk, and then this becomes a little bit more difficult, of adjustments in Medicare and Medicaid,
right.
not along the lines of Paul Ryan's plan, but more specifically in payments to providers. So this doesn't hit the senior citizens directly, it hits the providers. But what you do is you reduce the payments that they receive for various services, and then you put it back to the providers to figure out how to deal with that. Well, that could result in as much as 200 to 300 billion in savings.
Okay.
All right. So now we're
about 500.
We're adding the numbers. Then there was a proposal in the Simpson-Bowles Presidential Fiscal Commission to switch from the Consumer Price Index to the chained Consumer Price Index. And that proposal has been reiterated and it's under discussion. Now, why does that matter? Well, it matters because a lot of items in federal tax law are indexed to the Consumer Price Index. So, for example, Social Security payment adjustments annually are fixed off the CPI. And so are certain adjustment factors in the federal tax code, deduction amounts and things of that sort. The chained CPI, without going into the details of its composition, has over the last several years averaged about 0.2% less per year than the CPI itself. So if you adopt it, you're going to reduce the amount of the annual increase, whatever the CPI tends to be. And that actually is worth about $250 billion over 10 years. Okay. Now, that one's also not quite as clear because you could argue that it involves tax increases to the extent that it's reducing the amount of the automatic tax adjustment. But you can get it, you could sort of fudge that if you want by saying, well, yeah, but it's not a tax increase, it's just changing the way in which you calculate the tax situation. Well, then you have, what are we up to here?
We're at 750 billion.
Yeah, okay, so that's actually maybe a third of the way there. But the rest will be likely in a conceptual basis. And what do I mean by that? Well, the Congress will say, we agree to reduce the deficit by 2.4 trillion over the next 10 years. We have these specific things that we're going to go after and put into legislation. And the remainder we'll just put under discretionary spending caps.
Okay.
Now, what's a discretionary spending cap? Well, a discretionary spending cap is simply, well, each year we'll set a target for what the deficit needs to be, and if the budget comes in and makes that deficit larger than that number, then the difference gets taken out pro rata across the board. Well, what does that mean? It may not be out of Social Security, Medicare, but it could be out of things like defense and all other aspects of the budget. But what you do is you kick the can down the road basically for a period of time and say, hey, we're just committing to do this. We'll figure out later on the exact details of how we're going to do it.
For the sake of coming to an agreement now.
For the sake of coming to agreement now. And I say it's discretionary because nobody is talking about having hardwired mandatory, if this happens, then you have to automatically cut. So Congress would still have the opportunity in the future to back off.
Right.
Or I think that would be less likely because there's going to be a tremendous amount of impetus psychologically and politically created to actually follow through. So discretionary spending caps are likely to have the majority of this decrease, and it will be easier to get there because it's conceptual and it leads to a later time the battles over specifics.
Right.
All right. Then you don't, if you can get up to that number, actually 400 billion of the deficit reduction is in interest savings because you're issuing less debt. All right, so if you go backwards and say, well, the target is 2.4 trillion, 400 billion of that's in interest, then you really only get 2 trillion, and 750 million of these cuts that we talked about and 1.25 trillion of discretionary. It actually isn't too far-fetched. It's actually quite conceivable. So it's for that reason that I have optimism that actually a deal will be struck, and we'll see.
Great.